Selling options always have higher percentage probability of victory. So if I think that the market is going to go up, instead of buying naked calls, which I earlier used to do, what I do is like I sell the put options. So for instance, that instead of buying a call option, I would sell a put at $90. But I would just not sell the put. I also need to have my risk covered. So I'll buy a put that is cheaper. So I'll buy a put at $89. So I sell a put at $90 and I buy a put at $89. And that way my risk is limited. Of course, my profit is also limited. My profit is limited to the credit that I got by selling the put option. But I also bought an insurance for myself just in case that the market does not go in the direction in which I want it to go. So it is not always the most profitable way of trading markets, but it's almost certainly the most sure way of making money and minimizing your risks. Of course, if the market goes in your direction, you would be much off buying call options, but you are never absolutely sure that the markets would go in your directions, and markets do go in the opposite direction of your bet. So I suggest that you never sell a naked call or put option, because that would have a huge margin requirement and that would be a very risky business. And you should always buy and cover your risk, so that even if the market do not go in your direction, your risk is limited. And what I generally tend to do is that I take 30% of the premium for my spread. So if I sell a put at 90 and buy at 89, so the spread is $1, right? So I'll try to get a 30 cent of this contract. When I try to make this contract, you can even try to get 50 cents or 60 cents, but that would make your probability of winning lower. So if you get 30 cents out of this contract, your probability of win would be 1 minus 30%, which would be 70%. And if you get a 70 cent out of this $1 spread, your probability of winning would be $30. Your profit would also increase since you got $70 as a credit in this spread, but your probability of winning would decrease. It's like a seesaw. So if your probability of winning increases, your profit margin or your profit decreases. And if your probability of winning decreases, if you decrease your probability of winning, your profit increase. So that's how it works. But the most out of 5 years of trading, what I have seen is that instead of buying naked call options or naked put options, the most probable way of making money in these markets are selling options, but never a naked option. You have to hedge the option that you sell, because when you sell an option, your risk is unlimited, and you don't want that. Your profit is limited and your risk is unlimited. You don't want that. You have to limit your risk. And as an option seller, one of the positive things that you have is that the time is working for you. When you buy an option, the time is working against you, the theta decay, right? You want the stock to move in your direction as quickly as possible. But with selling options, the time is working for you, because you want your option to expire worthless at the expiration, so that you get to keep the whole credit. But when you buy an option, you want it to go in your direction as quickly as possible, because if it takes some time to go in the direction that you wanted, you'll have a theta decay and you won't get that much profit. Of course, there are times when I buy naked calls or naked puts when I am pretty certain about the direction of the market, but that's not my general trade. Generally, I try to sell options so that it limits my risk. Thank you for watching this video, guys. Please comment, share, subscribe, and smash that like button. It really helps.